You think you own a piece of the market. Millions of Americans do. They opened a brokerage account, bought a few shares of an index fund, and told themselves, I'm investing now. I'm building wealth. I'm part of the system. But here's the thing nobody tells you. You don't own the system. Someone else does. And your money is helping them get there. Let's go back about 20 years. In the early 2000s, most financial advisors still told people to pick stocks. Choose a good company. Believe in it. Hold on. But average investors kept losing. They bought high and sold low. They chased hot tips that went cold. They paid fees to fund managers who, most of the time, couldn't even beat the market. Then a simpler idea gained traction. Stop trying to beat the market. Just buy the whole market. Index funds were built on this idea. Instead of picking individual stocks, you buy a basket that mirrors the entire S&P 500, or the total US market, or even global equities. Low fees. No guessing. Just steady, automatic ownership of everything. It seemed like the perfect democratization of investing. And in many ways, it was. By 2023, passive index funds held more US stock market assets than actively managed funds, for the first time in history. Trillions of dollars poured in. Millions of ordinary people, many of them first-generation investors, finally had a seat at the table. Or so they believed. Because while the money came from everywhere, the control went somewhere very specific. Meet Chris. Chris is 31 years old, living in Portland, Oregon. He works as a project coordinator for a mid-sized logistics company, earning around $62,000 a year. He's not rich, but he's not struggling either. After rent, car payments, groceries, and student loan installments, he has maybe $400 left over each month. 2 years ago, Chris started contributing to his employer's 401k. His HR department gave him a list of fund options. Most of them were expensive, actively managed funds with names he didn't recognize. But one caught his eye: a Vanguard Total Market Index Fund. Low expense ratio, broad diversification. Simple. Chris chose it, set his contributions to 6%, and moved on with his life. He felt good about it. He felt responsible. He was doing what every personal finance podcast told him to do. But here's what Chris didn't know. When he put his money into that index fund, he wasn't just buying stocks. He was handing the voting rights to his shares over to someone else. Someone with trillions of dollars in assets under management. Someone who sits in board meetings at Apple, Amazon, Microsoft, and ExxonMobil. Someone Chris has never met and never will. Here's the first hidden rule. When you buy an index fund, you don't control the shares. The asset manager does. Think about what that means. Owning stock in a company isn't just about financial returns. It comes with power. The power to vote on major decisions. Who sits on the board of directors? How executives get paid? Whether the company pursues a merger, cuts jobs, or changes its environmental policies. Every share carries a vote. And when you invest through an index fund, those votes belong to the fund company, not you. This seems like a small technical detail. It isn't. 3 companies manage more passive investment assets than any others in the world: BlackRock, Vanguard, and State Street. Together, they are sometimes called the Big Three. As of recent estimates, these 3 firms collectively manage somewhere between $20 and $25 trillion in assets. To put that in perspective, that's more than the entire GDP of the United States. And because index funds mirror the market, these 3 companies hold shares in nearly every major publicly traded company in America. Not a few companies, almost all of them. Research from academics at the University of Amsterdam and Harvard found that the Big Three are the largest shareholder in around 90% of S&P 500 companies. Not the second or third largest. The largest. BlackRock alone votes on behalf of shareholders at roughly 14,000 companies across 100 countries. When the board of a major corporation makes a decision, chances are BlackRock, Vanguard, and State Street were in the room. And they got there with your money. Now here's the second hidden rule. When the same investor owns competing companies, the competitive pressure between those companies changes. Imagine you own stock in 2 airlines. If they compete aggressively and drive prices down, one or both might become less profitable. That's bad for you as an investor. But if they quietly restrain that competition, if prices stay high, if wages stay flat, if market shares stay stable, your portfolio benefits. This is called common ownership, and economists have studied it carefully. A landmark study published in the Journal of Finance found that airline ticket prices were significantly higher on routes where competing airlines shared the same major institutional investors. The researchers estimated that common ownership raised ticket prices by somewhere between 3% and 7%. This wasn't because of a secret meeting in a back room. It happened through softer, systemic pressure. Executives knew who their major shareholders were. They knew those same shareholders also owned their competitors. And so the incentive to aggressively undercut, to fight for every dollar of market share, quietly faded. Similar patterns have been found in banking, pharmaceuticals, and telecommunications. Industries where competition once drove innovation and kept prices in check. Now those industries are increasingly owned, at the top, by the same small group of firms. Chris is contributing to his index fund every month. He might be earning a modest return, but he's also helping sustain a structure that quietly raises prices on the goods and services he buys every single day. So how did we get here? It didn't happen overnight. It happened through a quiet, decades-long shift in how American wealth gets managed. In the 1970s, a man named John Bogle founded Vanguard and launched the first index fund available to ordinary investors. The financial establishment mocked it. They called it Bogle's folly. Why would anyone settle for average returns when they could try to beat the market? But Bogle had done the math. Most active fund managers, after fees, underperformed a simple index strategy over the long run. The data was clear, and slowly the money followed. Bogle's vision was genuinely democratic. He wanted ordinary people to access the same wealth-building tools that institutions used, and he succeeded, up to a point. But the scale that made index funds powerful also created something Bogle himself grew deeply uncomfortable with. Shortly before his death in 2019, Bogle warned about what he called the index fund paradox. He predicted that if index funds kept growing, just 3 or 4 companies would eventually control 30% to 40% of all votes in corporate America. He called it a problem that would cry out for a solution. That prediction has largely come true. Think about what ownership actually means. When people talk about the market, they talk as if it's a neutral force, like weather. But markets are made of owners, and ownership means influence. Influence over how companies are run, influence over how workers are treated, influence over how much your medication costs, how much your flight costs, how much your bank charges in fees. The big three don't just manage money, they shape the conditions of modern economic life. And they do it, largely, without any democratic accountability. No election, no public debate, no vote from Chris. Here's where this gets truly strange. The same system that made investing accessible to ordinary people has also concentrated corporate power in ways that are historically unprecedented. These aren't villains. BlackRock, Vanguard, and State Street didn't steal anything. They built products people wanted. Products that are, in many ways, genuinely good for individual investors. But the aggregate effect of millions of people making individually rational choices created a collective outcome no one voted for. Consider the story of a pension fund manager in Ohio. His job is to grow the retirement savings of state employees. teachers, firefighters, nurses. Every year, he faces pressure to keep costs low and returns stable. And so, like almost everyone in his position, he moves money into index funds. It's the responsible choice. It's the fiduciary choice. It also means he is quietly handing more influence to the big three. Not because he wants to, because the system gives him no better option. This is how power concentrates without conspiracy, not through greed alone, through the logic of the system itself. The rules reward a certain behavior. Millions of people follow the rules, and the outcome at scale looks nothing like what any individual intended. Chris isn't funding corporate monopoly. He's just trying to retire. But the two things have become inseparable. There is a question that doesn't get asked enough. What does it mean to own something? When Chris checks his investment account and sees his balance growing, he feels ownership. He feels like a participant. And financially, he is, to a point. But the other kind of ownership, the kind that shapes how companies behave, how economies are run, how the rules of the game get written, that belongs somewhere else. We are living through the most widespread participation in financial markets in human history. More people invest than ever before. More money flows into the market every single day. And simultaneously, corporate power is more concentrated than at any point in the modern era. Both things are true at once. That's not a coincidence. That's the system working exactly as it was built to work. The people who understand this aren't necessarily richer than Chris, but they see the board differently. They know that in this game, the money is just the surface. Underneath it, the real prize is control. And control, it turns out, has never been cheaper to acquire. All you need is for millions of people to keep making the smart, responsible choice every single month without asking who benefits.